the spotlight.
Come in the
Yes, your
spotlight.
Chopin.
What's the focus of the stock market? Is the stock market on generic or any
It is generic.
Generic.
Yeah. So what I'm planning is like today most of the terminologies in the market, right? Today most of them have no idea. For example, depository. What is a depository? What is a depository participant? Most of them doesn't know, but
Yeah.
everyone has to be aware of this basic terms. Whenever you just sit in front of CNBC, you just have to understand what these guys are talking, like not just the stock tip, tip, right? So that is what my main intention is, to just help understand the basic terminologies, then take with the fundamental answer where my expertise are, because I'm a SEBI registered mutual fund advisor. In sense, in India, if you want to sell something as a mutual fund product, you have to have a regulatory authority that's saying that he's a guy you can buy from him. So there's a website where people can come buy on that particular website, and I can arrange them money. That is what as a passion I do. Apart from that, my interests are into product management. Like I was a product manager in an RWA company where we were tokenizing real estate. That is where like my interests are into fintech, where a lot of finance and technology, and both the place you can work is in the fintech. That's where I started my journey as a profession. And apart from this, I do manage people's money just for a passion. Yeah, I hope this session you guys will enjoy. Like, as I said about my introduction, right? Coming from technical background itself, I have a bachelor's in computer science, but done certain certificates, but for Indian regulatory body, not on an international, but I'm planning to do my charter as well down the line. But my interests are towards financial markets as well. So my today's agenda is for everyone, like whoever no idea about stock market, like where they have to start with. So that is where today we are starting, and subsequently we'll see what and all we have to learn when you want to just make money in this particular sector. If we take a step back and understand about the money, what we are having today is a digital money, but it all started with the barter system. Barter system is simple, that if someone wants to exchange for the objects itself, if you have a cow and you have 10 eggs, you want to just exchange for that. That was the barter system. That is one kind of currency we used to do. Then we went for the physical objects, similar to one common objects, something like gold, silver, and copper, because the barter system had a lot of disadvantage. That's the reason they started doing one common kind of global acceptance coins, something like gold, silver. If you have cows and you want to exchange for wheat, but you don't find the right buyer or seller, you just go for the gold as an intermediary. Then it comes the paper money, where governments have come and started minting money and backed by gold. Then comes the digital currency, where today we have all the cryptocurrency, credit cards, and a lot of things. Right? This is where we have started our the evolution of money, right? Okay. So the basic question would be like, why are we just understanding to invest? It's as simple as that. It's the term called inflation. Inflation is something that the price of the particular object just keeps going up. In simple words, the purchasing power just keeps going down, right? Today, if you want to buy certain things at 10 rupee, tomorrow you have to buy it at 12 rupee. There's the value of the money, you have to pay it more. One thing you can do it, you can invest somewhere, make that excess money, and you can buy the object. That is what we are learning today. Else you have to keep working hard in order to buy that particular object. That is the inflation in simple words. This is the price of the objects keeps going higher. Maybe because of other factors. Minting of more money, that would be more on economic and all, but just in simple, it's the value of particular objects is rising as day by day. What are the other objectives to invest? To build wealth, It can be for anything. Like we might having certain scenarios like you want to make money for marriage, for me at least. For other people, it could be for their education, and it could be any other scenarios, right? And one thing, most of the entrepreneurs or most of them, like Warren Buffett says, money should always work for you. That is what the principally it is seen as when it comes to money. So I think let's start like so basic. What is an asset and liability? One of my favorite authors, Robert Kiyosaki, has explained very well in his book Rich Dad Poor Dad. Says that an asset is something which adds money to your pocket, and a liability is something which takes out money from out of your pocket. In simple words, if you are staying at home and if you have bought that home, right, the money is going out because you have to pay an EMI, if you have to pay something, right, that is a liability. That is what the definition is. But there's a lot of debate on a house whether it's an investment or a liability. But when you want to understand what a liability is, it can be a car. When you purchase a car, the money is going out of your pocket, and every year you are just giving that for a particular maintenance. Again, you are giving out of the money. There's no inward remittance of that particular object. That is what an asset and liability difference is. I hope that it makes sense, like in definition wise or understanding wise. Right? Everyone understood? Okay, on assets we have two categories. One is the tangible one and the intangible one. Tangible is something where we have touch and feel. You are able to feel the object, something like real estate, gold, silver, copper, anything. And intangible assets could be something you are able to not see, but they do have value. Something like shares. Shares can be rematerialized, means it can be done on a physical format. But shares today are digitally transacted. But bonds also is one of the intangible assets, but they do have a lot of value. Cryptocurrency is also one of the intangible assets. So most of the people will be rolling around in these two categories, right? This is what we always invest in as an asset category, either tangible or intangible. And the other thing everyone has to know is the difference of equity and debt. Equity is something, a particular ownership of a company, right? You are basically putting money and asking the ownership. That is what an equity is. And the debt is something like you are just giving as a loan and getting back the money with certain interest principle and interest and a principal. You're not getting any ownership of that particular object or any business, but you are just giving as a loan and getting back the money with interest. That is what equity and the debt difference is. But we'll be mostly working on equity, not on debt, because let's first understand the equity markets, then we can go on debt market. So why do companies actually raise through equity? That is one question like most of them ask. Most of the companies, as they keep wanting to grow, the debt markets keeps asking for a higher, there's something called interest rate, right? They just want to pay them more interest rate. So there'll be a point where the company thinks that there's no point of asking the money from the people in form of debt. The other question is they wanted to sell their equity, not guarantee any returns, but giving the ownership of that particular business. That is what the companies always try to move from debt to equity. Until certain point you can keep taking debt, but there'll be a point that the interest rate taking from a loan from a particular bank would be more expensive for them, and it is more of brainstorming for the company to always have the mindset to give back the money after certain duration time. There's a commitment, right? When you take a debt, you have to pay back the money on monthly basis or weekly basis or yearly basis. Some companies really don't want to do that. And another is the taking out the money, the interest rates are higher. When these two things are not in their place, they try to raise money over equity. And when it comes to businesses are something like it can be anything which makes money for the group of people or for the group of other societies as well. We have businesses as private or public. Private, it can be as small as 5 or 6 people, or it can be as small as big as 250 people. Geographically, it all differs because the definition wise of a private company in India, it could be less than 250 people as a shareholder. For a public company, it should be more than 250 people onwards. It can be 50,000 people as well. So that's what a private company is. It can be a smaller company and it can be a bigger company also. but lot of companies we do know that they're not listed, but they have why they call a private, because the shareholding pattern would be limited, max to be 250 people. But in a public company, it is for everyone. Everyone can be part of owner, right? These are the actual main two types of businesses which you see around. There's a third category which is family businesses, which are run by big players like maybe Mukesh Ambani, Elon Musk. They have the individual powers to run the businesses. These are the types of businesses. I hope everyone is understanding, right? So why do actually companies raise money? It's as simple as that, to expand their business, to buy the equipment. Maybe you are a business where you wanted to expand globally. That's the reason you need money for that. Another thing is you have a loan, you want to just repay it back, and so that the loan as an interest component just goes out from your P&L statement. And for marketing and branding purposes as well. This is the reason why companies can raise. There could be other reasons as well, but these are the main reasons why companies look forward to raise the money for. And these are the like common terminologies used in most of the channels or most of the stakeholders whenever they come on the meetings to talk on. One would be, what is a security? Security could be something like a financial instrument which gives you the ownership of particular asset. Maybe a share or a bond which says that you have a contract with something, right? If you buy a bond, it's a contract note. Like it says that you're given so much money to that company with that particular interest, with that particular face value, and you're actually be getting this money within that duration of time. So that it's a security, like it's a financial security. So when we go to grocery, we buy certain things for our food and all. Similarly, when you want to buy a financial asset, we go to security markets where you can buy shares, bonds, right? That is where the types of markets also come into play. We have two categories. One is the primary market and the secondary market. Primary market would be something like an initial market where whenever a company wants to go to IPO, this phase they have to do it. What is the difference here is the money from the user, money from the investor goes directly to the company itself. That is what the primary market concerns are. Money going from the user to, yeah, please come. Money from the user goes directly to the company, right? So this is the primary markets scenario. Then comes the secondary market, where if someone has invested something in the primary market, they wanted the liquidity, right? They wanted to sell it back. This is where the exchange comes into play in the secondary market. You are ready to give your shares and someone is ready to buy your shares. That is where the secondary market, where the exchange plays a role, and they try to match based on the price and the quantity, whatever the other party is asking for. I hope this answer, everyone got an idea what a primary and secondary market is. You guys are open to ask any questions in between and just ask me. Okay, usually there are few things which you need to invest in market. One would be that you need a saving account, and one would be a trading account, and would be a demat account. Basically, again, this depends on the geographical location, but there is something like a trading account where you load the money for the trading purpose. It's not your on one of the savings account. There should be a certain different account, right, to load the money and trade it. And there's something called demat account where your shares are dematerialized and stored and are under the government regulator.
What does dematerialized mean?
Okay, so there's something concept of dematerialization and rematerialization. Priorly shares were traded in yeah, please come. You guys want to? Yeah. So priorly shares were traded in the form of booklets, like there were books, right? You were actually given the face value, and the share price would be shared directly. So there were clearing houses which they used to match the buyer and seller, and used to make a note of things, who is the actual buyer and seller. The concept of dematerialized came that the shares of the document would be converted as a digital format of share, where anyone who is buying will be today buying over demat format.
Okay. So you basically burn the paper. Okay.
So today, yes, the process is still available. Whenever you wanted to get the shares back in the form of sheet, it's called rematerialization.
Mm.
When you wanted to get back the shares certificate into form of demat, it's called dematerialization.
Is it a term for Indian capital market? And
Yes, it's
general?
general. It's general for everyone. Dematerialize and rematerialize.
Okay.
But this is what they use in markets. So you will see that lot of people in global market, they say that we are not sure about certain regulatory. We just rematerialize all our shares and put in our lockers. They don't believe, like they just want to keep their share certificate.
Okay. In case the computers get lost or something.
Right, something that. So that is what the demat is, where the shares can be traded. Today, most of the shares are in dematerialized format.
So you need both the trading account and demat account?
Yes.
But yeah, this is thing for Indian market. I have not heard demat account in US.
Yes, I think that is what
It's
in
not a
global
brokerage.
level, it all depends on the geography, whether how they're managing. Most of them don't say it's a demat, but every broker would having a different account.
Yeah, it's like savings account and then brokerage account.
Right.
They got it as a brokerage account.
Right. So in India, both the things are handled by the broker itself.
Mm.
But the bisection is done separately on the account itself. They don't say that we do that, but this is how it is handled for each user. There's a trading account, which is a sub account under the escrow account of the broker, where it is mapped to a particular ID, and there's certain demat ID for that particular user itself, which is mapped to the depository. Yeah, but it's quite complex. But yeah, every depository participant have their own trading account and demat accounts for individual level. They have to do it in India at least,
Okay.
right? Because today you are using Zerodha, maybe and one broker, and you want to move that particular trading account to other broker itself. You have bought in Zerodha, it doesn't matter, but you can just move because the demat account is with other party. You can just directly link with that particular shares. This is the third party itself, the demat form. It's a third party. So it's not under the broker, at least in India. It is handled by a company called CDSL and NSDL. It's in the independent body, and it's under SEBI. It's a government body.
Okay, so basically, it's a third party that holds these, like the accounting of the shares,
Right.
and brokers is trader, right?
So broker is just like you can say in technological terms, an API who's just asking to transfer the certificate.
Mm.
Money, clearing house is doing all the processes, NSDL and CDSL is taking care of the shares. They don't have any rights here, right? Because if the broker is given again the complete ownership of owning the shares, he can misuse it. So
Yeah,
there's
yeah.
a third party here again to handle this.
Got it. So that's the way to, like what happened with FTX.
Right. So at least in India, this is what it is followed. But globally also, there are other third parties that are following this procedure, but
Yeah.
they don't say openly this is what they do. This price band, so IPO, like there are a lot of companies where they come for raise money. There's a price band which companies wanted to do it, and there's a lot of back-end process which how this process of price band comes. But usually they come with 15 or 20 rupees difference, or it can be more. The lower band may be 100 to 150. This is what the companies wanted to raise price for. The lower band would be called 100 rupees, and the higher band for 150. You can maximum, you can basically quote for 150 rupees per share. And there's a lot size. Lot size is something like the minimum amount of shares you have to buy for that particular IPO. For example, let's see this example. You guys will be able to understand. Price band of a DMart, maybe a listed IPO company. So they told that the price band is from 290 to 300, right? And you have an option to bid at this price, bid at this price, bid at this price, and bid at this price. Maximum number of people who bid at the maximum price is at 82, or the 90% of the subscription has happened at this price. Whoever have bid the price above this are just rejected. The money will be just given back. Whoever the people who have been from here to this one will be succeeded. Like the money will be taken out from them, and the shares will be given to them. You see that there's an excess money of 5 rupees here. because the 295 was the price at which the shares were allotted. The 5 rupees money will be refunded back to the user itself.
Settle that for nice.
Right. So this all process are done in the back end, but most of the people will ask why they are not able to get their IPO allotment. It's because of this criteria. You have to always try to get put it in the higher price so that the chances of getting their shares are higher to them.
So is it in real time? You can see the order book, or you just submit and like see what happens?
No, usually it is given as a time period of 3 to 4 days, the IPO processes.
Okay.
And you'll be able to see for every 20 minutes, 30 minutes, there are private companies where they're able to see that how much subscription rate is happening on each category level.
Okay.
So the category again depends. You have something called as a retail investor category, and HNI category,
Okay.
and FII category, and DII category.
Okay. They have like allocations.
Yes,
Ah,
yes.
So the matching of all of them happens in the same price, or?
No.
Oh, okay. So-
Happens on the same price. That is what I'm saying. No?
Ah, okay.
Happens on the same price, but again, this principle they'll be holding it.
For all of them, but allocation for the amount is different for each
Yes,
category.
yes. So for example, DIA would be given 35%, retailers would be given 30%, and FIs can be given 15 or 20%. On that category, again they play this game.
Right.
The maximum whatever price they'll be doing. There are certain cases where this category itself means there's something called a subscription percentage. It should be around 90% or 85%. If the subscription goes below, again on the geographically they decide what percentage has to be minimally done. If it goes below that, there's someone called as underwriter who comes and plays his game. He comes and he says, okay, fine, you guys have subscribed to me, I'll put the rest of the money so that you guys are done with the IPO process. And he will be given particular fees or whatever they would have spoken to the company itself. So this is what it happens. And the person who does all this IPO process, giving the shares and raising the money, because initially the company would need someone help to do all these processes. The price band, how it is done, there's a lot of calculations, right? This is all done by the merchant banker, who is the backbone of this particular thing, who plays an important role during the IPO process. And as I mentioned, there's the minimum lot size given for all the category. There are certain categories called a small SM stocks, small medium stocks, where the lot size would be at least 30. Means if anyone have with 5,000 rupees, 10,000 rupees, he will not be able to do that. He should be having at least 2.5, 3 lakhs to do that. Or
3
maybe
lands?
3 lakhs,
Lakhs.
maybe $3,000, something.
Okay, per transaction, per buy?
Yes.
Why?
It is a smaller company, so it depends. Like they're not encouraging the smaller, the other retailers to come and participate.
Okay, so you should pay large prices.
Yes,
right?
they just want to take a very minimum percentage from the retailers. Again, who is able to put a bigger check size.
Okay.
So again, this lot size is all done under merchant banker, and merchant banker has to go under certain regulatories where what has to be done. Whether it's a small and medium case, the lot size would be different. If it's a bigger company, the lot sizes are different. I think more, as I explained, IPO, most of them have gotten at least an idea. It is an initial public offering. There's something called as offer for sale. Like most of the people would have listened in the CNBC saying that some company is looking for offer for sale, OFS. What do you mean by that actually? In simple words, there could be a scenario, and I could be a founder, and I would have raised through IPO, and I've got some shares and sold some shares to people in the secondary market. After 5 years, I really wanted to raise more money and give some shares, but I really wanted to make money as well. So what I do, I give shares from mine. I really don't want to use that money for the company, but I want to use it for myself. That's where the offer for sale comes, where you're actually giving the money to the founder, not for the company. So a lot of OFS happens in the government companies where they are selling their stakes to the people, saying that we wanted to dilute because we wanted to use that money for something else. Usually private companies doesn't do that, and the public companies also don't do that. Government companies, PSUs, something that will be usually doing this. They will
Why?
be
Why?
because as a founder, if you are selling your own stake, it seems like a bad sign, right? Like
Okay.
you really don't want to sell your own stake to the market until you are basically saying what is the reason. Government has a reason saying that this money is particularly utilized for something else.
Okay, so whose money, whose stock is sold in the end? Like existing share, so they opt in or something like that. Like I tell another person like sell your shares
No, it's not. It's only from the promoter.
from the
Promoters.
promoters.
Promoter could be someone like who is having the maximum shares.
Ah, okay, okay. Someone a large, a major shareholder like we need this, you sell.
Right.
Okay.
So let's take an example. We'll
Okay, got it.
Government also runs businesses, right? They have their own shareholding pattern. Initially, they would have done their IPO process, and after a certain time, they wanted to sell their own stakes. Right? That's where the offer for sales come, where the share capital table